Root, the new Root IPO, ticker ROOT or Root stock. It's an insurance company. Since its IPO just a few weeks ago, it is down 50%, 50% from its IPO price. This is creating a potentially interesting investment opportunity, and they're growing their business very quickly, over 40%. And in one scenario, this stock could be up over 190%. And I'll walk through that later this video. This video goes out to Paul, who's an Unrivaled Investing Journey subscriber, as well as to all my Unrivaled Investing Journey subscribers. And on that note, before digging into Root stock, which I think you could pencil out as having potentially 190% upside, first 10 seconds about this channel. So you're watching Unrivaled Investing. My name is Daniel. This is a no-hype, mission-focused channel on finding you exceptional companies and unrivaled investments. I always look at things through the lens of, is this company unrivaled? And if you like learning about potential multi-bagger stocks that can go up hundreds or thousands of percent, make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up. And if you want to follow my personal journey to try to find potential multi-baggers, go to unrivaledinvesting.com, click on Journey. Okay, now we'll dig into Root, which is actually a really interesting investment setup. So what is Root? So they are looking to revolutionize auto insurance, where it's about collecting more data, getting proprietary risk scoring based on the data you have. And it's better data, let's say, than the rest of the industry, which is better than how the industry currently does it, which segments it based on, let's say, geography or age or income or credit score. And because you have better data that results in better scoring, and you're using methods that the others aren't, you can have better pricing. And better pricing can drive more customers. And then you get more customers, you get more data. So you get this beautiful flywheel. Okay, so what makes them special? What actually makes Root special? And I would argue it's because they're a mobile-first company, effectively taking the supercomputer that's in your pocket and saying, hey, you can't just let this new development go by without dramatically changing the auto insurance landscape. And simply, you look at this and it's like, download the Root app. If you want to get a quote, you give it a try for about a 2 to 4 week driving period, where based on your driving, they'll tell you how you score. Like, oh yeah, you're 10 out of 10 based on the drivers we see. Or you know what, you hard brake a little too much, you make those fast turns. Maybe you're a distracted driver. And we'll get into that in a second. Based on all these things, here's your quote. You can manage your plan. And by the way, in the unfortunate aspect that you have some sort of accident, yeah, you can do that also with the app, with industry setting turnaround. So what does mobile first even mean? Looking at all these things, because it actually goes a lot deeper than this. First, it actually has to do with customer acquisition cost, or acquiring new customers, where they talk about, through our hyper-targeted, data-driven, and ever-improving performance marketing capabilities, we've been able to acquire customers for below the average cost of doing so through each of the direct and agent-based channels, i.e., we're able to acquire customers at a lower rate. So on a per-customer basis, we can acquire them cheaper than our competitors. That's a really interesting point, because this is not, the auto insurance landscape is inherently competitive. There are a lot of auto insurance carriers. So you need to stack up lots of potential competitive advantages to really crush it over time. So for them to say, oh yeah, we think we can do this cheaper acquiring new players because we're mobile focused, that strikes me as interesting. One clever way of being mobile focused is by looking at mobile apps that people use that are related to driving. For example, they have a partnership with an app called Gas Buddy that helps you, locate and get to the nearest gas station, and also helps you with your mileage. And that's used by 6 million active users. Well, wait a second. If you're using a app that's already looking at your location and driving, and let's say getting the most out of your miles, that's not too far away from using an app to get you better car insurance. So you could say, and that's used 6 million active users. That could be a huge potential customer base. 75% of their new customers for this company, for Root, are via mobile acquisition. So 75% of their customers are effectively through mobile first. This is a revolution relative to how the marketplace historically sourced customers. At an average cost of a little over $300 versus a 6-month average policy of a little over $900 for their insurance. Let's say assume a gross margin of 25%, might be more than that, depends on how it fares over time. But that implies a lifetime value to customer acquisition cost of around 3 times, a little under. That's not great. This also assumes about a 2-year, life of the customer. This could be much, much better if, for example, people stick with Root for more than 2 years, or if their margins are better than 25% over time. So if you're able to, let's say, get 3 years or 4 years for your average customer, and you're able to get 30% margins, then that lifetime value to customer acquisition costs could be much higher, which starts getting very interesting. Just from the better this ratio is, the better the underlying economics of the business. Another aspect about where mobile first can dramatically change the business is with claims processing, where the claims initiation process begins in-app for 90% of our reported claims. Once again, mobile first. The customer confirms certain policy information, shares details on the incident, including whether any bodily injuries occurred, and uploads photos with the guidance of the app, which directs the customer to specific photo angles that are the most useful. We immediately begin triaging the claim based on the expected complexity and severity. The claim is then directed to an adjuster with experience in the projected claim evolution. During the claims process, our customers can check on the status of the claim and connect with the adjuster if they so choose. This is the key part here. Our average cycle time is 5 days, less than half industry average of 12 days, with 13% of repairable claims paid within 24 hours for first-party physical damage. That's really interesting to me. In addition, their app enables auto damage appraisers to write estimates from photos, which is less expensive than a field inspection, and we save storage and rental fees due to shorter cycle times, i.e., if we can do this all via having a virtual set of eyes on the crash versus having to send someone to physically inspect it, put a car in some storage where there's going to be physical inspection, you can dramatically lower your cost of processing claims. Which is interesting because here it is, you'd think, well, wouldn't there be fraud or wouldn't there be issues there where, this just isn't a smooth process? And here it is, they're talking about their loss adjustment expense, which is effectively their loss processing expense, like how much does it cost them to process this, was 9.5%. That's as a percentage of the revenue, which is better than the industry average. Once again, better than industry average. So faster and better than the industry average of 11%. Our advantage is primarily derived from the efficiencies we achieve with a technology-enabled in-house claims team. Wow, I'm starting to see several potential competitive advantages stack up for being a mobile-first insurance company. Mobile first can also lead to better pricing. And, here it is, you're driving your pricing because it's based on you doing a test and it's tracking how you drive with several different variables. And they're not using the traditional metrics that everyone else is. They're not using zip code or occupation and credits. It's less weighted to the traditional things, the things that other insurance companies use to segment the market. Age, credit scores, to price your coverage. We don't think that's fair. When we offer a rate, your behavior behind the wheel gets more weight than any other single factor. They're going to weigh how you perform, and that's how they price it versus all these other things that everyone else does that segments the market. We're committed to removing credit scores from our pricing entirely by 2025. With Root, the safer you drive, the more you could save. So this is not just about driving less and being charged on a per mile basis, which I've covered in another company and I talked about that. This is about a holistic approach to saying, hey, it's not just about how much you drive. It's about focused driving. Are you distracted? Smooth braking, gentle turning. Root claims that their usage-based insurance score is nearly 10 times more predictive than the industry-leading usage-based insurance algorithms, or effectively what Progressive might use. So how do they assess your driving? So it's about the mobile phone, the supercomputer that's in your pocket. There are many variables from mobile data that go way beyond the segmentation, let's say, of your zip code, of your age. You have so many things going on in your phone, like accelerometers, gyroscopes, GPS, the calendar. That's a big element. A key aspect is, what time are you driving? If you're driving between the hours of 1 a.m. and 4 a.m., the odds are you're more likely to get into an accident. That's what statistics show, which is surprising. Behavioral elements like, hey, am I distracted? Am I checking my phone? Okay, so it includes all these different variables, lots and lots of different variables. So how does this set them apart? Well, it's interesting. It's all about removing the bad drivers. And so, for example, in the 5 years since founding Root, we've developed industry-leading and highly proprietary telematics and data science capabilities. We're particularly proud of our ability to discern distracted driving, meaning driving a meaningful driving risk that cannot be measured effectively by original equipment manufacturer integrated car data or dongle devices provided by carriers. That is the alternative that you typically see. And I'm sure a lot of folks are thinking, well, there's a lot of players that offer similar competitive things like these dongles or insurance carriers that connect to the OEM data. But what they're saying is you're actually missing a key component, which is distracted driving. The National Safety Council reports that 1 in 4 accidents in the United States is caused by distracted driving. So the ability to measure distracted driving is paramount to a strong telematics program. In addition, actions like hard braking cannot accurately be used to forecast loss cost without a corresponding claims data set and other contextual behavioral data captured via mobile telematics, which Root possesses in spades. I.e., if you just have certain things like a dongle that captures, let's say, how hard you're braking, that isn't enough. If that's not capturing, let's say, where you drive, maybe you're in an urban setting where it requires more that stop and go environment. So they're saying, and you also don't necessarily know how that translates into the claims. How much does it, on average translate into a claim? So it's really interesting to think that they might have a data edge on distracted drivers that otherwise isn't available in the marketplace. So this all translates into excluding the bottom 10 to 15% of drivers. And here you can see their business model, data collection from mobile telematics and claims, development of this usage-based insurance score, integration of weighing how you perform based into the pricing. And that results into them saying, you know what, 10 to 15% of the drivers, boop, we're not willing to write your insurance. We're walking away from this business. And that gets me excited in the first place. Like having a company that's saying, hey, we have standards. We're going to make a point of saying we're not willing to underwrite part of the market. But this is where it gets even better. They then, because they recognize, hey, one man's trash is another man's treasure, let's take this 10 to 15% of the market, this bottom decile of the market, and there's another insurance carrier that's going to want to have this lead. And this is a customer that's looking for an insurance carrier. They then resell the lead to other carriers. So that helps offset the cost of acquiring them as a potential customer. I think that's incredible. Now, what does underwriting out, so excluding the bottom drivers or the bottom, part of the industry, have to do with them wanting to grow faster? So why would Root want to grow faster? How does this sort of go hand in hand with each other? And it's tied to this, where this is a quote from their prospectus filing, where, however, when a competitor prices a driver based on traditional underwriting variables for certain risk segments, our price will not be the lowest and we will not convert the potential customer, i.e. this is the bottom 10 to 15%. We view this outcome as mispriced risk, accruing to a competitor's balance sheet. As our flywheel turns and more mispriced risk converts with our competitors, our competitors are put in a position of having to broadly raise prices to meet profit expectations, improving our conversion. i.e., as they get more and more of the top drivers, all of their competitors will be left with more and more of the bottom drivers. And so their competitors will see worse and worse loss ratios. And if they see worse and worse loss ratios, they're going to have to raise prices just to keep their profitability. And if they're raising prices, then all of a sudden the value proposition for Root gets even stronger because they're correctly pricing the rates for the top drivers. So this strikes me as really interesting. It's about, hey, make sure that our competitors get the bad drivers. This really does create the incentive to grow as fast as possible. But wait a second, isn't competition like a really big factor? Like, I'm talking about all these potential unrivaled, or competitive advantages that can make Root an unrivaled value proposition, like having a lower cost of acquisition and better processing and better pricing. But isn't there a lot of competitors? Well, yes, there are a lot of competitors. This is a $260 billion market. So that's US alone. So if they could figure out a mousetrap that it does indeed work, if they're right, that they are building a strong or unrivaled value proposition, then they're tapping into a huge opportunity, 10x opportunity type setup. Now, some of their competitors already are using, OEM data or those dongles or an app. They do have a usage-based element. For example, Progressive has Snapshot, and Progressive is one of the largest auto insurers in the United States. But interestingly, Root Management still thinks, despite the legacy insurance carriers introducing things like usage-based pricing, that there's still a huge opportunity to disrupt the market. Because when I see this, I think, you're not going to be unrivaled. But they make a really interesting point. And it's all about Innovator's dilemma. For those that aren't aware, it's when something new comes to the marketplace. This was a concept developed by Clay Christensen. He wrote a great book on it called The Innovator's Dilemma. I highly recommend it if you haven't read it. But the key point is that a new either product or aspect of a market develops that might seem marginal, but over time it actually results in completely disrupting the core players. What was once deemed a insignificant part of the market becomes very significant, becomes increasingly better, and the legacy players that didn't want to distract themselves with dealing with an insignificant, marginal part of the market realizes that they've completely been outclassed as, let's say, a competitor dominates using a new approach or dominates by starting, down market and working up market. So here it is, management in Root thinks this is a classic example of Innovator's Dilemma, where incumbents face a classic Innovator's Dilemma. If an industry incumbent sought to implement telematics-based pricing across its customer base, it would risk large-scale lapses as customers react to those price changes. This risk of cannibalization simply outweighs the benefits to the legacy players. Some have argued that industry players face such Innovators' dilemmas all the time. But unlike traditional variables, telematics data is collected by these carriers after they have acquired customers and spent an entire 6 months term with them. We believe Root is the only carrier with scale and focus working to implement telematics-based pricing up front. They go on where, telematics, mobile first will disrupt the existing pool. And they go, our telematics are different because they're built on a proprietary integrated data set of complex behavioral data tied directly to actual claims experience. And we use the power of this data across our entire portfolio. In fact, behavioral driving data is the first thing we look at when considering a customer's risk, i.e. mobile first, let's price it based on their behavior. And in the case of the 10 to 15% highest risk drivers, we underwrite out these customers without considering any other variables. Get rid of the bottom 10 to 15%. You don't need to look at anything else. You just know based on their driving. You're done. To highlight this difference in approaches from other providers, we note that Progressive, one of the largest competitors, recently acknowledged on its earnings call that although telematics is their most powerful rating variable, they solve it last in terms of their pricing algorithms. That, in my opinion, is the equivalent to a smoking gun. Like that does sort of fit the idea that this is facing the potential innovator's dilemma type thing, where you have these legacy players and they don't want to disrupt their model, where they might have to have significant churn or turnover based on using usage-based pricing versus their current segmented approach. That could be really interesting. That means that Root can start off with this approach and get market share and disrupt these players, where they all of a sudden are stuck with the crappier drivers and have to raise prices, creating this sort of virtuous cycle for Root. Okay, so what do consumers think of Root? So this is the Google rating of 3.6, stars, which is not great in my opinion, but I think you're going to get a bimodal distribution. It's going to be weighted to two different, endpoints. For example, you see two drivers here that maybe previously would have been priced out based on geography or credit score, or any other factors, and they're giving 5 stars saying it was a great experience, they love it, and it's the most affordable despite whatever background they have. It prioritized their driving over everything else, which that means a lot to them. Yet you're gonna get the folks where it's like, hey man, I'm not a below average driver. Like, why am I getting 1 average star? Like, this sucks. This app sucks. Like, why am I getting charged more? Because it starts on a pre-telematics price, and then after your 2-week to 4-week trial, then it's like, oh, here's how much it's going to cost you. We'll let you know. So, I wonder if structurally this is a problem longer term, because you're going to get 15% of your customer base, presumably, that will be outspoken critics of like, yeah, man, you suck that I'm such a bad driver, effectively. But it's also far from perfect. Here it is. This is an EMT who's like, look, I'm a great driver, but the app, unfortunately, classifies me as a risky driver because it also catches when I'm driving the ambulance, and it doesn't know which is which. And they acknowledge that that's a problem that they haven't, fixed yet with their app. And I should also note that in the Apple App Store, it actually has a much higher rating of 4.7 stars out of 5, which is actually much more favorable than even Progressive, which here has only 3.5 or 3.6 stars. So I guess it depends on which marketplace you're looking at, whether or not it's iPhone users or Android users. But overall, like 4.7 seems pretty interesting, and 46,000 reviewers is pretty good. Here it is. This is 30,000 reviewers. So a lot of 5 stars, though. Interesting. So I would say proving that consumers love you above all other brands, that you don't necessarily have. And part of that is sort of this exclusivity aspect of saying, hey, we're purposely not going to underwrite this bottom 10 to 15%. So why has Root stock collapsed? It's down about 50% in just a few weeks. It IPO'd in October 2020, and now it's IPO'd at around 27, and now it's at 14. And what's interesting is that not only did it IPO, but concurrent with the IPO, it had a private placement for around $500 million, which was split between Silver Lake and Dragoneer, which have both had several, intelligent investments that have worked out quite well. So it's interesting to see that they made an investment in 27. It's now down 50% in just a few weeks. Does this create an opportunity for potential investors? So first, in the short term, anything can happen. I always tell that to potential investors, and that's something I always believe when I invest in anything. Like, I always expect, like, hey, this could be disastrous in a few weeks. Like, maybe this drops 50% first. So I always mentally think about that when I'm buying something. That said, one reason that I suspect it's down is potentially algorithmic in nature, where their reported revenue is down 40% in the third quarter versus being up over or around 135% during the first half of 2020. So going down 40% in their revenue versus being up 135% is a big delta. And if you had an algorithm or the computers that were buying and selling, and they see, oh man, we're looking at first half data of 135% revenue growth and then negative 40, like what's going on? It'd sort of puke all over that. And what's going on is that they had a reinsurance contract that started July 1st where they're transferring 70% of the risk to reinsurers. Part of the reason why they're doing this is this enables them to scale faster, where they're able to get, a much larger book of business when you're sort of offloading a significant portion of the underlying loss. The faster you grow, the sooner you're able to scale your costs. And they call this out. This reinsurance program is exactly what we need to allow our equity capital to drive growth and build a deeper moat around our technological advantage. And that's what really matters, i.e. getting more and more data about how to price customers and also get scale on your sales and marketing and your G&A. Reinsurance has implications for GAAP revenue, and our new reinsurance program will cause a reduction in GAAP revenues versus prior quarters. This is why we use direct earned premium as our primary top-line metric. This is a key aspect, and we'll get to that when we look at the valuation in a second, which is that you should effectively look at what are the premiums being written by Root in total before they cede anything to the reinsurers. And then you should, because longer term, as they get to scale, they're not going to need those reinsurers, think many years out. And if you don't need the reinsurers, then you keep all of that on your books. And so it'll be based on the profit of that total amount. So when I'm thinking about the investment, you should be thinking about the direct earned premium, so the total, before any of their premiums are effectively being sent back to the reinsurers. And there is a contract with the reinsurers where if they send business their way, they do get a commission back. So it's not like it's just completely lost. It's also possible, so if the stock is down because of this aspect where it's this reinsurance contract that started July 1st, and that's the start of the third quarter, and it's because of this gap decline in revenue. This could imply a really interesting buying opportunity if it's just the computers being stupid. And that I would honestly believe that is one possibility. Another possibility is just that it's a new business. You still have this uncertainty about customer churn and their loss ratios. Or maybe it's just monkeying around in the stock market where animal spirits are sort of taking over. Possibly, concerns about policies in force declining from the second quarter to the third quarter where they're like, wait a second, why are your policies in force declining? Shouldn't your policies be growing over time? And management, articulates that, look, our policies actually dipped slightly quarter over quarter from second quarter to third quarter because in the second quarter we pulled back significantly on marketing, which was really a response to COVID, where it's like, hey, we need to see what's going on before we push pedal to the metal. That said, they're still growing very quickly. Their policies in force year over year are still up quite significantly. So I would say there's a lot of monkeying around here in terms of why the stock is down, a lot of sort of conjecture on my part of like what could actually be driving it, but I'm not seeing a fundamental key aspect of like, yes, this business is structurally weaker over the last few weeks that would warrant a 50% haircut from the recent valuation. So what are my thoughts on the valuation now that it is 50% lower? So it is around $14 a share, which based on 250 million shares outstanding is about $3.5 billion valuation. So I prefer to look at the direct earned premium, which is around 600 million currently. This for 2020. And then for 2021, I'm doing an assumption of growth of 25 to 37.5%. They're currently growing around 40%. They're growing way faster, pre-COVID. So there's a chance that this is actually really low. Now, what are the optimized margins here? The optimized margins, I'm putting 5% on the low side. And this is really, at the end of the day, the low side shakes out to down 70%. I wouldn't focus too much on the low side because I'm trying to just sort of create a down, like the reality is it could go way lower than that. If they're not able to prove out their business model, if they're not able to prove out their margins over time. And that's sort of what I was sort of spitballing at here with this 5%. The reality is if they're not able to prove that they can be more profitable over time and that this whole mobile first approach works, then you're going to have a lot of downside. It goes without saying, like, look, if you're not actually revolutionary and you're competing with these huge behemoths that are very profitable, you're going to lose. That said, management is pointing out a lot of things that makes it interesting. And keep in mind, this is my value proposition to you, whereas I put this sheet, available for you to play with, where you can think about, what's the risk reward. I think it's very interesting that they were growing over 100% before the third quarter, in terms of premiums. So Root is a very, and if you walk through this analysis, I do 12.5 to 15%. If you look at Geico's historic, operating margins, you're looking at a teens rate, let's say 10 to 15%. So this is like, hey, can you get best of breed operating margins based on the advantages that you've already articulated, like your ability to acquire new customers at a lower rate, more affordably than, let's say, your competitors? Can you underwrite them at a better price? Can you process the claims at a better rate relative to your business model? And so those things all get into this margin. And keep in mind, this is my way of excluding the impact of the reinsurance, which really creates a lot of volatility here, by thinking what's the total of the premiums that are being earned by the business before any ceding of the premiums to the reinsurance company. Slap on a tax rate, and you can see what the underlying optimized margin earnings are. So in the high side, it's saying 38 times. Then what's the growth rate? And I'm putting 20 to 30%, but honestly, there might be a little, recency bias here with the way I'm doing it, because I'm effectively looking at the most recent quarter, 40% growth, and sort of saying, what, maybe that sort of slows down over time. But management has indicated every indication of saying, look, we're going to get back to pre-COVID marketing spend. We should be accelerating our growth. So maybe this 30% is actually low. In which case, this high side is saying, look, there's increased confidence that they're going to prove out their economics in their business model. You're going to be able to grow at an attractive rate, 30% over 5 years. And 5 years from now, you'll get a 30 times multiple off of this theoretical margin. In which case, you have over 190% upside in the next 5 years, which is actually quite interesting. Because there's a lot of pieces here where I could be off on the downside. For example, if the growth rate is much higher than 30%, let's say it's closer to 50%, then this risk reward is dramatically different. So I look at Root as a very interesting company. They potentially have a revolutionary product and a depressed stock price. The $10 billion question, in my opinion, is can they prove that they'll have sticky and profitable business over time, repeat customers coming to them? Or will this, effectively diverting 15% of potential customers sort of cripple their business over time with bad reviews? Will this sort of model of saying, hey, you have this you have this trial period and then you get your rate, well, is that just too much change for consumers, resulting in higher churn? If they can prove out the profitability of this business model, the inherent advantages that they think they have in this business model, if they can prove that out, that they've articulated, I would say, in a very reasonable way, then I would say that upside scenario might even be conservative. And keep in mind, this valuation doesn't include the cash that's on balance, but part of that's due to the fact that I expect them to have significant cash burn in the years ahead. That said, they can't have too much because they're an insurance company. They need to have cash on the balance sheet. They need to keep their equity. So if they're able to prove out their business model, the $10 billion question, can they, and here it is, a $10 billion valuation. If they can prove out their business model, then you get the $10 billion valuation and multiples from here, just in the next few years. The next question is like, well, what am I going to do? And do I have any sort of exclusive thoughts on Root? I do, and I will create an exclusive video that you can click on below in the comments, but that's just for Unrivaled Investing Journey subscribers. This is one of the perks that I offer Unrivaled Investing Journey subscribers, one of which is this type of exclusive content. The other aspect is each month having one potential new multi-bagger, and another aspect is sharing my portfolio, what I buy, what I sell, what I hold, what are the potential multi-baggers that I own. And if you see my portfolio, you'll actually see I have a reasonable hit rate with the multi-baggers that are in my portfolio. And the reality is just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find potential multi-baggers, go to unrivaledinvesting.com, where I'll also be putting this exclusive content, my follow-up thoughts on Root, because I can't capture it here all in this 30-minute video. That will be available for Journey subscribers in the exclusive video before. If you enjoyed this video about Root, I really appreciate the thumbs up. I appreciate the subscribing to this channel, Unrivaled Investing, and thank you so much for watching.